Volatility returned to the major markets last week, sending all 5 indices lower. The greatest losses were seen in emerging markets and the tech-centric NASDAQ, which lost 6.35% and 4.92% respectively. The pullback in the equity market was largely due to a spike in interest rates. The 10-year yield reached a high of 1.61% intra-week, surpassing the S&P 500's dividend yield of 1.51%. This also reflects a rate 50 basis points higher than the 10-year's January close. This crossover in interest rates was an ominous sign for the equity market, which up until recently had thrived on low interest rates. Nevertheless, Fed Chairman Jerome Powell seemed largely unfazed by the recent increase in the bond market's interest rates, and reiterated the Fed's commitment to low Fed funds rates until their goal of maximum employment and inflation have been reached. Furthermore, Powell said that the Fed will not raise the Fed funds rate until they have reached the inflation goal of 2%, saying that, "We believe we can do it. We believe we will do it. It may take more than 3 years." Currently, the Fed's preferred measure of inflation is about 1.3%. However, inflation is already beginning to appear in some measures. The Food and Agriculture Organization of the United Nations reported the 8th consecutive month of increases in their food price index, which also reached a 7-year high. Regardless, the recent movement in interest rates spooked the markets. 10 of the 11 sectors ended lower, with energy sitting with an impressive 4% gain, thanks to continued increases in the price of crude oil. By the end of the week, the Bloomberg Barclays U.S. Aggregate Bond Index shed another 36 basis points to close February with a year-to-date loss of 2.15%.